Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today, we're looking at Micron Technology.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So, let's get into the analysis.
Yeah, let's do it. When you look at the recent numbers, the term supercycle starts to feel less like hype and more like a fact.
It really does. Everything points to this being something more than just a typical rebound.
So the fundamentals, they just look explosive. We saw fiscal Q1 2026 revenue come in at, $13.64 billion?
That's right.
And that's a 56.7% year-over-year surge. For a company that used to be defined by these commodity cycles, that's hypergrowth.
It is. And it's almost entirely driven by this massive synchronized AI infrastructure build-out.
Okay.
Think about what it takes to run these huge language models. They need specialized memory and tons of it.
Right.
But what's maybe even more remarkable than the Q1 results is the guidance they gave.
For Q2, yeah.
Management is projecting Q2 fiscal 2026 revenue to climb even further to around $18.7 billion.
That's a huge jump, quarter over quarter. But the number that really defines this for me, it's not even the revenue, it's the margin expansion.
Absolutely. And that's where the whole supercycle story really cements itself.
So what are they targeting?
They're anticipating a massive 68% non-GAAP gross margin for Q2.
68%.
Hitting that kind of number is, it's just pure pricing power.
That margin really suggests they're in the driver's seat. We saw notes that pricing for both DDR5 and, more critically, high-bandwidth memory HBM are seeing these double-digit increases. Are we talking about pricing that could actually beat the peaks from the last big cycle back in 2018?
We are. And the key difference is the product mix. The 2018 cycle, that was all about commodity demand. Smartphones, PCs.
Right. Consumer stuff.
Exactly. This time is driven by the AI server mix, which demands HBM. And that's a highly specialized, complex chip.
So it's a totally different game.
Completely. When you look at the segments, their cloud memory revenue, which is where the AI business lives, hit $5.284 billion in Q1 with, get this, 66% gross margins.
Wow.
They've basically shifted away from consumer stuff and straight into this premium data center market. It's a fundamentally different business.
So the financial picture is solid, but what's actually holding all that up? This gets to their competitive moat, right? Their technology.
It does. And what's fascinating here is that the moat is built on pure tech leadership. They have a leading position in advanced DRAM and HBM.
It's not just selling more chips, it's selling the right chips.
Precisely. The HBM market alone is projected to grow at a CAGR of 40% to reach something like $100 billion by 2028.
A 40% growth rate to $100 billion. That sounds incredibly bullish. Is that realistic?
It's aggressive, for sure.
Yeah.
But it's grounded in the reality that every major tech company is building AI models and needs this specific memory, like yesterday. The immediate problem isn't demand. It's supply.
Supply, exactly. And that tech edge leads right to supply constraints, which for investor just means pricing power. We saw that their HBM capacity is fully allocated all the way through 2026.
Right. It's completely booked.
So what does that lockdown mean when competitors like Samsung and SK Hynix are also trying to ramp up?
It means Micron controls the near term. That supply tightness lets them dictate pricing and protect their market share.
Ah, I see.
The moment a competitor raises HBM prices, it just validates Micron's own premium price point.
Right.
And this scarcity has let them make a really powerful strategic move. They're actually getting out of the low-margin consumer business, the crucial brand, by February 2026.
That is a massive commitment. It's more than just freeing up factory space. It's like a declaration.
It is. They're taking capacity that used to go to the volatile PC market and shifting it directly to these higher-value AI server contracts.
Which gives them much better visibility on revenue, I'd imagine.
Way better visibility. And it makes the business far less vulnerable to, the usual economic ups and downs.
And they're backing the strategy with some serious cash. I saw the note about the, $1.5 trillion?
Yeah, which is about $9.6 billion committed to HBM investment in Japan.
And they're using government incentives to help, which is just smart planning.
That financial planning is absolutely key. And it brings us to their overall financial health. They've got strong liquidity. The current ratio is 3.3.
Okay, for the listener, what does that mean exactly?
It just means they have $3.30 in current assets for every dollar in short-term debt. It's a huge liquidity cushion.
And why is that cushion so important right now?
It's essential for funding their aggressive capital plan, about $20 billion for 2026, without straining the balance sheet. They generated a record $8.41 billion in operating cash flow in Q1 alone.
So they're basically funding their own hypergrowth.
Exactly.
Now let's shift from the fundamentals to how the market is reacting, because this is where it gets really interesting. The stock's performance in 2025 was just remarkable.
It really was.
It surged 240%, and it closed the year at an all-time high of $294.37. That kind of action shows the market is fully buying into this supercycle story.
Oh, it confirms it. You can see the institutional interest is strong. I mean, you have big investment banks like Goldman Sachs filing special securities linked to the stock.
Which is basically a proxy for deep institutional belief in the long-term upside.
Right. And technically, the chart itself looks incredibly strong. It's showing clear golden cross dynamics.
Where the shorter-term averages cross above the long-term ones.
200-day, yeah. It essentially means the short-term momentum has just completely taken over the long-term trend. It's a very clear signal.
And the analysts are all on board, too.
Completely. We've seen these big upward revisions in price targets, $330, $325, $328. That kind of agreement suggests the street believes this is a multi-year story, not just a one-quarter wonder.
Okay, it's a compelling case, but let's put our skeptic hat on for a minute. The memory market is, at its core, cyclical. So what are the biggest risks that could derail this?
And we have to ask that. The risks are real. I'd say the top three are pretty clear. First, just cyclicality itself.
The classic memory trap.
Exactly. Competitors will eventually respond to these high prices by adding more supply. When that hits the market, it could squeeze those really nice gross margins.
Supply always catches up. What's number two?
The demand cliff. Hyperscalers are spending billions right now, but what if they overinvest?
An AI CapEx normalization, as they call it.
Right, a spending pause. Or they build up so much inventory that by late 2026, they just stop ordering for a few quarters.
And the third risk has to be tied to all that spending they're doing.
Correct. Execution risk. That huge $9.6 billion investment in Japan is a massive project. Any delays, any problems with manufacturing yields, or cost overruns that could seriously hurt their returns.
Those are all valid structural concerns, but what is management doing to sort of buffer against these risks?
The main thing is supply discipline. It's very strategic. Management guidance has been explicit that their bit supply growth for non-HBM memory in 2025 will actually be below what the industry demands.
So they're intentionally keeping the commodity market a little tight to prop up pricing.
That's the strategy. Undersupply the commodity market while you focus on the high-end HBM market where demand feels almost infinite right now.
And the second mitigation is that big pivot we talked about.
Yes, getting out of the consumer business. By exiting Crucial, they're swapping out volatile consumer demand for these long-term AI contracts.
Which gives them that revenue visibility we mentioned.
Right. It creates a structural buffer against that cyclical risk.
Okay, so if the foundation is sound and the risks are being managed, what are the near-term catalysts we should be watching, say, over the next 3 months?
The first and most obvious one is the Q2 earnings report. That's expected sometime between late January and late March. The market has incredibly high expectations.
They'll be looking for a beat and another big guide up.
Exactly. Any sign they're accelerating HBM delivery will move the stock.
And since this is all tied to the AI ecosystem, any news from the big players must be key.
For sure. You have to watch industry events like the NVIDIA GTC conference in March.
Because new GPUs always need newer, faster memory.
Always. Any partnership announcements or design wins for Micron that get mentioned there would be an immediate catalyst.
And lastly, the physical infrastructure itself.
Yep. We need to watch for updates on that Japan fab build-out and any news on HE-SHEP-S Act funding here in the U.S. Speeding up those projects just reinforces their long-term supply advantage.
This all paints a really compelling picture. Micron Technology really does seem like a crucial picks and shovels play on this whole AI megatrend. They're leveraging this structural supply tightness for sustained pricing power.
And that's what's fundamentally restructured their business model, moving them away from that old consumer risk.
It really feels like a potential multi-year hold benefiting from this entire AI infrastructure cycle.
When you look at the strategy, the execution, and the financials, the thesis seems very strong.
Well, thank you for walking us through that. If you want more analysis into market trends and stock catalysts just like this one, make sure you hit that subscribe button before you go. We'll be back soon with more.